$3 billion in gift cards go unused every year. That's not a typo. $3 billion. Money that people paid for, money that's just sitting there on plastic cards or in digital wallets. Never spent, never redeemed, quietly turning into pure profit for retailers who did absolutely nothing to earn it. And that's not an accident. That's the entire business model. Gift cards exist because they read the perfect financial product for companies and the worst possible deal for consumers. But we've all been convinced they're a thoughtful, convenient gift. What's the worst gift card you've ever received that you never used? Tell me in the comments, along with your city, and if you're starting to realize that gift cards are a scam dressed up as convenience, hit that subscribe button and turn on notifications. This channel exists to say what retailers desperately hope you never figure out. My name is Alex, and I used to think gift cards were genius. Practical, flexible, no risk of buying the wrong thing. If you didn't know what someone wanted, you just gave them a gift card and let them choose. It felt like the perfect solution to the age-old problem of gift giving. I gave them, I received them, I thought everyone won. Then I started looking at the actual numbers behind the gift card industry, and I realized the only winner is the retailer. Always. Let me start with the scale of this industry because most people have no idea how massive it is. The global gift card market was valued at $1.24 trillion in 2025. Trillion, with a T, and it's projected to nearly triple to $3.81 trillion by 2034. In the United States alone, the market is worth over $447 billion and growing at over 11% per year. This is not some niche corner of retail. This is a fundamental pillar of how modern commerce works. And here's the thing that should make you suspicious. Gift cards are more profitable for retailers than almost any other product they sell. Not because of what's on the card, but because of what never gets used. The industry has a term for this. It's called breakage. Breakage is the portion of a gift card's value that never gets redeemed. The customer paid for it, but they never spend it. That money just converts directly into profit for the company. No product shipped, no service rendered, just pure revenue. How much breakage are we talking about? Estimates vary, but industry data suggests that anywhere from 10 to 20% of gift card value goes unredeemed. Some reports put the total amount of unspent gift card money in the United States alone at over $21 billion. $21 billion that consumers paid for and retailers kept without providing anything in return. Imagine any other product where the company just keeps your money and you get nothing. We'd call that theft. But with gift cards, it's just standard accounting practice. Let me tell you exactly how this works, because the mechanics are designed to maximize breakage. First, you buy a gift card. The moment you hand over cash or swipe your card, the retailer has your money. They don't owe you a product yet. They owe you future purchasing power. But here's the critical part. They're betting that a significant percentage of people will never actually use that purchasing power. And they're right. Think about your own experience. How many gift cards have you received that are still sitting in a drawer somewhere? Maybe you used $40 of a $50 card and never bothered to go back for the remaining 10. Maybe you lost the card entirely. Maybe it's a store you never shop at, so the card just languishes in your wallet for years. Maybe you forgot about it until after it expired. All of those scenarios are breakage, and they're incredibly common. One survey found that 37% of consumers admit to letting gift cards expire before using all the funds. Another study reported that the average American has about $175 in unused gift cards just sitting around. Multiply that across millions of people, and you start to understand why retailers absolutely love gift cards. It's free money, and the beautiful part, from the retailer's perspective, is that breakage is predictable. They can look at historical data and estimate with reasonable accuracy what percentage of gift cards will never be fully redeemed. That number goes straight onto their balance sheet as projected revenue. They know before they even sell you the card that a certain percentage of the value will convert to profit without them doing anything. Let me give you a real example of how profitable this is. Starbucks reported in 2024 that they had $1.77 billion in unredeemed gift card balances globally. That's almost $2 billion that people paid Starbucks but haven't spent yet. And a significant chunk of that will never be spent. Starbucks literally has a line item in their financial statements for breakage revenue. It's a core part of their business model. Now, you might be thinking, okay, but gift cards are convenient. They solve the problem of not knowing what to buy someone. And yes, on the surface, that's true. But let's examine what gift cards actually do compared to just giving someone cash. If I give you $50 cash, you can spend it anywhere. You can save it. You can invest it. You can use it for anything you need or want. It's completely flexible. If I give you a $50 gift card to a specific store, I've just restricted your options dramatically. You can only spend it at that one retailer. You couldn't use it for rent or groceries or gas unless the gift card happens to be for a place that sells those things. And here's the kicker. Statistically, you're likely to spend more than the value of the gift card. Retailers know this. It's called spillage. Spillage is the opposite of breakage. It's when someone uses a gift card but spends more than the card's value. Say you have a $40 gift card to a clothing store. You find a shirt you like that costs $60. You end up spending $20 of your own money to use the gift card. The retailer got you in the store with the gift card and then extracted additional money from your wallet. That's not a coincidence. That's the design. Studies show that the majority of people who use gift cards end up spending more than the card's value. They call it the gift card uplift. The average person overspends by about 38% when using a gift card, so that $50 gift card often results in a nearly $70 purchase, with the extra $20 coming out of the customer's pocket. The retailer wins again. And let's talk about what happens to gift cards that never get used at all. In some states, after a certain period, unclaimed gift card balances are supposed to be turned over to state unclaimed property programs. The idea is that if you didn't use your money, the state holds it for you and you can claim it later. In theory, that money eventually goes to public service programs if it's never claimed. But here's the problem. Not all states have strong unclaimed property laws for gift cards. In at least 19 states, retailers are required to work with state programs, but enforcement is inconsistent. Tracking is difficult, and a lot of money just disappears into corporate balance sheets. And even in states with good laws, the process of reclaiming your own money from a gift card you forgot about is so convoluted that most people never bother. Now, let's talk about digital gift cards because the industry is shifting hard in that direction. Digital gift cards are projected to grow even faster than physical cards, with some estimates showing growth rates of over 16% per year. By 2032, the digital gift card market alone could be worth over $770 billion. Why the push toward digital? Because digital cards have even higher margins for retailers. No printing costs, no shipping, no physical inventory to manage. You buy it, they send you an email or a code, and it's done. Instant profit. And digital cards are just as prone to breakage as physical ones. Maybe more so because they're even easier to forget about. That email gets buried in your inbox. You forget to add it to your mobile wallet, and 6 months later, the money is effectively gone, even though technically the card hasn't expired. Here's another angle most people don't think about. Gift cards are essentially interest-free loans to retailers. When you buy a gift card, you're re-giving a company your money up front, with no guarantee of when or even if you redeem it. In the meantime, they get to use that money. They can invest it, they can use it for operations, they can do whatever they want with it. You get nothing until you actually spend the card. And if you never spend it, you've just given them a free loan that they never have to pay back. Think about how backwards that is. Normally, if you give someone a loan, they pay you interest. With gift cards, you give the retailer a loan, and they pay you nothing. In fact, you paid them for the privilege of loaning them money. It's the ultimate scam, and we've been conditioned to see it as a normal, even thoughtful, part of gift-giving culture. And let's not forget the psychological manipulation at play. Gift cards feel like free money when you receive them. You didn't earn it from your paycheck. It's a gift. So your brain treats spending it differently than spending your own money. You're more likely to buy something frivolous or expensive. You're less sensitive. The money doesn't feel as real, even though it is. Retailers know this and they exploit it ruthlessly. I want to tell you about a study I came across that perfectly illustrates how predatory this model can be. A company gave each of their 200 employees a $500 gift card for Christmas. That's $100,000 in total gift value. Sounds generous, right? But using global breakage estimates, up to $20,000 of that will never be spent. The gift card company keeps that money. Meanwhile, the employer still pays taxes on the full $100,000, as if the employees received all of it. So the employees lose out on $20,000 of value. The employer pays taxes on money the employees never actually got, and the gift card company pockets the difference. Everyone loses except the card issuer. That example is corporate gift cards, but the same principle applies to personal gift giving. Every time you buy a gift card, instead of giving cash, you're introducing the possibility that some or all of that value will be lost to breakage. You're also locking the recipient into shopping at a specific retailer, reducing their flexibility and increasing the likelihood they'll overspend. So why do we keep buying gift cards? Part of it is social conditioning. Cash feels impersonal. We've been told that giving someone cash is lazy or thoughtless, while a gift card shows you at least considered what store they might like. But that's marketing propaganda. Cash is objectively better for the recipient in every measurable way. It's more flexible, it never expires, it can be used anywhere, and there's no breakage. The other reason is convenience. Gift cards are easy. You can buy them at the grocery store checkout, you can order them online, you can email them instantly. They require zero effort or thought, and retailers have made them as frictionless as possible because they know the easier it is to buy a gift card, the more money flows into their breakage revenue streams. I stopped buying gift cards 3 years ago. If I don't know what to get someone, I give them cash. If that feels too impersonal, I write a note explaining why I'm giving cash instead of a gift card. I tell them I want them to have complete freedom to use the money however they want, without restrictions, without expiration dates, and without enriching a corporation that's betting they'll forget to spend it. The reactions have been mixed. Some people appreciate the honesty and the flexibility. Others seem uncomfortable with cash, like I've violated some unwritten rule of gift etiquette. But I'd rather give someone something they can actually use than participate in a system designed to extract value from both the giver and the receiver. If you absolutely must give a gift card, here's my advice. First, only give cards to stores you know the person shops at regularly. Don't give a Target gift card to someone who never goes to Target. That's just setting them up for breakage. Second, give cards with no expiration dates and no fees. Some gift cards charge maintenance fees after a year or lose value over time. Avoid those completely. Third, follow up. A month later, ask if they've used it. Remind them it exists. The number one reason for breakage is people simply forgetting they have the card. But honestly, the best solution is to not give gift cards at all. Give cash, give experiences, give your time, give something homemade. Give anything other than a product specifically designed to benefit retailers at the expense of the recipient. The gift card industry is worth over $1 trillion and growing because we've accepted a fundamentally broken transaction as normal. We pay money for a product that has a built-in chance of becoming worthless. We restrict the recipient's choices. We enable retailers to profit from our forgetfulness. And we do it every single year, billions of dollars at a time, because we think it's polite. It's not polite, it's a scam. A very profitable, socially acceptable scam. And the only way it stops is if we stop participating. Give cash, give real gifts. Give nothing if you can't think of something meaningful. But stop handing retailers free money and calling it generosity. So that $50 gift card you're thinking of buying, just give them $50 instead. They'll thank you, and ULL have opted out of a system that's designed to take advantage of both of you. In the comments, tell me about the gift cards you've received and never used. How much money is just sitting in a drawer or lost in your email? Let's add it up and see how much we've collectively given away to this industry. And if you're done being part of the problem, subscribe for more honest breakdowns of the systems we've been told are normal, but are actually designed to extract as much money from you as possible. See you in the next video, where we'll probably ruin something else you thought was fine, because that's what we do here. We ask the questions retailers hope you never think about.